Chapter 2. In this chapter, we basically focus on the balance sheet and income statement. We review the balance sheet and income statement. And for balance sheet, we focus on the asset and the liability valuation. Income statement, we discuss the income and expense recognition. And we know we have different methods of valuation for balance sheet. Currently, we call it mixed attribute accounting. The reason is there are lots of assets and liabilities reported in the balance sheet. They have different characteristics. So if we rely on a single attribute, the information usefulness will be discounted. So for different assets and liabilities, we apply different valuation. So that's why we call it mixed attribute accounting. Actually, currently we use historical fair value and also the hybrid of both historical and fair value to measure assets and liabilities. And we also know the definition or two foundation quality of useful information is relevance and reliabilities. So information to be useful, it must be relevant and reliable. However, in some cases, some information may be more relevant but less reliable. For example, fair value. For some assets, we know fair value is relevant because it represents the current economic value of the assets and liabilities. But sometimes we cannot have the reliable market value for the assets and the liabilities. Historical value, it is considered reliable, but it will lose relevance. It will lose relevance when the time goes. So the purpose of mixed attribute accounting is to improve the usefulness of accounting information. So actually, the choice of different valuation methods depends on the trade-off between relevance and the reliabilities. So the valuation of assets and liabilities actually is to reflect the company's both historical data, current information, and also show us the future outcomes. That's the purpose of valuation. Okay, I talk about why we apply mixed attribute accounting. Because it provides an optimal mix of relevant and reliable information in the financial statements. It is an optimal way to fix the trade-off between relevance and reliability. And this accounting model helps users to better understand and assess the risk of the business and also predict the timing and amount of future cash flows. So in this exhibit, it shows us three different valuation methods. Historical methods, which we all know. We have already known what's historical method, right? Some assets When we value them, we use acquisition cost, adjusted acquisition cost, and also initial present value. And also, this applies to some liabilities too. Current methods includes the fair value, current replacement costs, net realizable value. And actually some are hybrid of both. Actually here the replacement cost, current replacement cost and net realizable value is a hybrid of both historical methods and current value method. Okay, acquisition cost. It is easy. It represents the amount paid initially to acquire the asset. Right, so it actually includes the invoice price or any other costs to get the assets ready for use. For example, inventory, property, plant, equipment. We apply the historical acquisition cost. When we initially acquire the inventory and long-term fixed assets. Adjusted historical cost, like to reflect the current economic value of assets, we make adjustment to the historical cost. For example, depreciation. Right. So when we acquire a building, we record it as an acquisition cost. But after years, we should recognize depreciation to show its current economic value. Otherwise, the value of assets will be overstated. So we should recognize expense and also reduce the historical value of the assets. That's what we call adjusted historical cost. Present value, we know in the finance literature or class or in the accounting courses you learn how to calculate present value. Right? So the present value represents the present value of the assets, a present value of future cash inflow and outflows. Especially this is very popular in financial assets and liabilities. Right, so we can value the investment in bond, equity by using discount future cash inflows. We can also value the liabilities that represents the discount value of future cash outflow. The fair current value, the most important is fair value. So fair value under FASB is exit price. Under IASB, International Accounting Standard Board, is exit or entry price. So fair value is more relevant. Actually, fair value apply most to the financial assets because we do have the stock and capital market to reflect their current price. So these markets are active and the price of these financial assets or debt, they are available. Also, current replacement cost. What's the current replacement cost? It is a cost to reproduce or acquire an assets. Okay, so it is very close to the fair value, but actually when we apply it, we also combine with a historical cost. So that's what we call it. It is a hybrid method. Net realizable value. It is the value when we dispose an assets, the sales price of the assets. Remember, we use a lower of cost and market for inventory, right? So this is the methods actually hybrid methods. We pick the value which is lower between cost and net realizable value. So that's the valuation for assets and liabilities. Remember, no matter what valuation methods we use, our purpose is to maximize the usefulness of financial information.